Property Patriot, you are cleared hot.
Good day, high flyer. I'm here today with Trevor Oldham, a successful real estate investor who retired in his 30s. He's going to share with us how he did that and how you can retire early too. Trevor had a unique starting point in his real estate career, started investing in his early 20s. In this episode, he'll share his secrets to retiring early with real estate. Find out how he started, his setbacks, and how he overcame them to grow in the industry. Find out all of that and more where we provide real estate investors with the tools to achieve generational wealth. Welcome to the Aim High Podcast, show number 43. Good day, high flyers, and welcome to the Aim High Podcast. I am your host, the Property Patriot, Bud Evans. I am here with Trevor Oldham. Trevor, how are you today?
I'm doing good, Bud. Excited to chat.
Yeah, likewise, man. You have a very interesting take on real estate, but before we even get into that, do me a favor and give me a quick intro.
Yeah, that sounds perfect. So I'd say, first and foremost, last 6 years, I would run a company called Podcasting You. Really just started that up out of my dorm room on a whim. And then long story short, today we basically help real estate investors get booked on podcasts for any number of reasons. And then because of that, I found my way into real estate investing myself, and I'm a passive investor in about 4 different deals right now. Haven't hit the active side. I like the passive side. I don't have to deal with what's the 3 T's, tenants, termites, and toilets. I just get that ACH, that wire transfer coming in every month, but I do enjoy investing as a passive investor as well.
That's awesome. Now, it's funny, man. Tenants, termites, and toilets. I love it. I'm actually dealing with 2 out of the 3 of those right now. So as a long-term investor, but what got you into, you said you started this thing out of your dorm room. What made you want to get into real estate?
Yeah, I think for me, it was just looking at all my clients that are very successful. They're paying us anywhere from a couple $100s a month to a couple $1,000s a month. And I was looking at them and I'm like, I want to be like them. A lot of them are younger. We have clients that are in their 25 and 30s, and you realize that they're financially independent. I'm like, I want to be financially independent. And it just piqued my interest. I'm working with investors all the time. I'm talking to investors all the time. And I always thought to myself, how can I go out and buy a $5 million apartment complex? In my mind, I'm picturing I got to raise $1 million or invest $1 million of my own money. And then that's where I got turned on to syndications, where I realized I could put $50K into a deal. And yeah, I'm not owning the deal outright. I might own 1 to 2% of the deal, but then I don't have to deal with any of those headaches that I had mentioned earlier. And that's just not something I would want to do at this point in time. So that really turned me on to that passive side of investing. That's really what got me started. I was like, hey, these clients are very wealthy. Why don't I just do what they're doing? And then I realized I don't want to manage a deal, but I can invest alongside my clients. And I've invested in a couple of different deals that they're doing. And for me, it was more like a numbers game. I look at the stock market. Historically speaking, you're going to double your money in 7 years, say in a perfect world. Where in real estate, I'm always looking for a 2x equity multiplier over 5 years. So if I can double my money in 5 years versus 7 years, you start to crunch the math. I could retire potentially 15 years earlier by investing in real estate versus just keeping it in the stock market. So when I did that math, it was almost like a no-brainer. Why not just start investing in real estate as well?
Yeah, great point, man. It's all about the numbers, isn't it?
Mm-hmm. Yep.
So let's go over, what was your first deal? How'd you wind up getting into it?
Yeah, so the first one, I just wanted to do something, for the first couple, just want to do something simple, just monthly cash flow coming in. So I invested in a private note fund. So that was just paying anywhere from 8 to 11%, paid monthly, yearly, paid monthly, and then got into that. And then about a month later, also for the cash flow, I got into a triple net lease deal. Right now, it's a fund, so there's about 5 different properties. It's a couple of different family Dollar General buildings, and then they just added 2 different vet offices to the fund. So there's about 5 total properties, similar 7 to 10% paid annually, paid monthly. And I just like that for the initial cash flow, because for me, if I'm putting in 25 or 50K into a deal, I just want to get that cash flow, because I had never done that before. Like all you hear about is investing in the stock market. And so this was, even though my clients had did it, it wasn't something that I had necessarily done before. And I was still like a little bit skeptical of it. And then once I started, I invested that money into the deal, started getting that monthly distribution. That really opened my eyes up. And that led me to realize I want to be a little bit more aggressive. So like in my next deal, I'm going to self-storage development deal. You probably won't get any cash flow until about I believe it's 12 to 18 months, but the equity multiple on that, looking at the numbers, you're looking at 2.9 over 5 years. So even though you don't get anything upfront, you get a lot of money on the back end. So I like the approach between the two. I like the initial cash flow when I was first doing it, but I like the aggressive play on that self-storage deal where the numbers look good. It looks like a good deal, but I'm also relatively young where I know if I put the money into the deal and it goes belly up, yeah, it sucks. But it's not like it's my retirement money. Like I'm in retirement right now and I need that cash flow. So that's how I looked at those couple of different ones when it came to investing in them.
Great. Trevor, I got to tell you, every time that I have a new guest on the podcast, I find there's always some nuance, something that maybe I didn't have on the show before, and you just nailed one. For those who are listening or watching on YouTube, there are ways to invest in real estate without actually, it's just a fund, right? Can you go a little bit more into that?
Yeah, most certainly. So basically, it's like instead of me going out there investing in a multifamily deal, say by itself, they basically package together, say for this opportunity, 5 different buildings together, and then I'm getting basically a small percentage of the piece of each of them. So for this particular deal to get into it, it was $25K minimum. So it wasn't like through like a Fundrise or a Yield Street where the minimum's $500 or $1,000 and there's tons of investors.
Right.
For this specific deal, it was $25K. To get into it, it was set up as 506B. For those listening who don't know what that is, you have your 506C, 506B deal. Difference between the two, 506C, the sponsor can advertise the deal as much as they want. 506B, you have to have a pre-existing relationship with that person. I'm non-accredited, which means I fall under that 506B bracket. So definitely a little bit trickier to find those deals. But when I found the sponsor that I liked, I had been talking to her for about 3 or 4 different months, taking a look at her deals, attending her webinars, and then I eventually just pulled the trigger and invested in that. But when you get like your K1s, you get the 5, I think it's 3 states. There's 5 buildings. It's like Arkansas, West Virginia, and I believe it might be Delaware. So you have those 3 states. You get the different K1s that are coming your way during tax time. But I never thought of it really as a fund. I was like, if I could own these 5 buildings, and you own a very small percentage of them, you own less than 1% of each building. On that $25,000 investment, I look at it as if I could hypothetically get 10% a year, that's 200, let's say about $200 a month you have coming in, give or take. If I could continue to build that up and continue to compound that, I start to look at it. If I invested $25,000 in a real estate deal, like for me on an active side, on a small multifamily, on a single family, if I got $200 a month in cash flow, that might be decent, but I probably want more than that if I was going to be active. But then, I have to deal with those headaches. So for $200 a month coming in on that one deal, it makes sense to me to get that cash flow without having to be active, and you're still getting a decent return. And 10% is still beating the stock market. And then for me personally, I just get that $200 a month coming in from this deal, and then a different deal and another deal. And then all of a sudden you look up and you have $500 a month of income coming in that's passive. It's outside of my job. Mm-hmm. And then you look at, if these deals do good, like this triple net lease doubles in 5 years, I get $50,000 out of that investment. And then the other deal, I put in another $25K. I get $75,000 out of that. I reinvest that. Now that basically $500 a month I was getting in 5 years could be worth $1,100 a month. And I start to look at that number and I'm like, is that what's going to allow me to achieve early retirement? And then I'll continue to invest in real estate. Outside of that set, for me, our expenses are pretty low between me and my wife. And I just look at it as the passive side, as somehow I can use that to potentially retire early. And that's how it worked. You have to have that pre-existing relationship, which I did. Talk to her multiple times. And you honestly just have to pull the trigger. That's the hardest part, is just wiring that check over for 25 grand. And it's only hoping and praying it goes well, because you hear sponsors from time to time. I'm sure you've heard that sponsor out in Houston. He burnt $300 million. But at the end of the day, you still got to know what you're doing. And that just comes with research. You look at his deals, it was like 80% loan to value, no cap rate. You just look at that, like, it doesn't make sense. For this triple net lease deal, it was 5 to 7 year leases, all AAA rated credit tenants. So that's like your Family Dollar, Dollar General, your Fortune 100 company. So it just seemed like a nice, stable play. The numbers made sense. And that's really why I pulled the trigger on that one.
I would say. And I got to ask, as far as the fund that you jumped into, When you're dealing with bigger values, obviously it's not as liquid as the other companies that you mentioned. I'm not going to mention them. We're not sponsored. So if you're talking about a $500 minimum investment, they're usually a little bit more liquid. It's a little bit easier to get your money back. The bigger the fund, the more money you have to put in, the harder it is to get your money back out if you were to need it, because it's a limited number of investors. Is that what you found as well?
Yes, correct. And I would say for that, I think I went going in knowing when you're investing in these deals, I always say expect to not get that money back. Obviously, you want to get that money back, but it's not like the stock market where you have your brokerage account and it's very liquid. It's going to be very illiquid. And let's say that I need that 25,000 that I invested in this deal. Like, I need to get that back. What you have to do is you'd have to sell your shares back to another investor or a sponsor. And I haven't done this, but I know that it's typically I'm selling my $25,000 in shares back to the sponsor at 80 cents on the dollar. So I'm only getting $20,000 back. So you typically don't want to do that. So you have to just know when you're investing in these deals, you just have to be in it for the long haul and accept that this can't be money you're putting into these deals that like you're going to need tomorrow. It can't be your emergency fund, your backup plan that you're putting into these deals. You just have to accept that, hey, I put in 25K. I'm not going to see any of that money outside your typical cash flow, your distributions until 5 years down the road.
Yeah, great point. Have you ever had any one of them that went south?
So far, no. They've all been good. I think part of it is one's just been in these stable assets, so the private mortgage notes, this triple net lease, very stable. In that self-storage development deal, obviously there's more risk on it. It's undeveloped land. They got to pull permits. They got to put the buildings out there. They got to rent the units out. So that one's been, I invested in that one back in February, put 25K into it. Haven't received any distributions like that. You watch the monthly reports that they do. It's moving right along, which is good. And then I got into a multifamily deal. I think it was 140-ish unit, 130-ish unit. I believe it was right outside of Dallas, Texas. So got into that deal because I just wanted to do multifamily. Haven't received a distribution on that deal, but that's like more your typical value add deal. So I haven't experienced anything bad yet. If I were to say, it would probably be the more risk would just be these multifamily and the self-storage deal. But then you're typically going to make more money on those deals where the mortgage notes, the triple net lease, comparable probably to what you get in the market, where these ones are obviously your IRR at the end of the day could be anywhere from 15 to 18%, which is definitely better than what you get in the market. But yeah, nothing's gone south so far. And I think what helps me is I'm a part of like an investor community. So it's all for like passive investors. So you can see a lot of the sponsors of who not to invest with. People will share their insights. So that was a big learning curve for me, was joining that group and realizing like, hey, don't invest in this sponsor. And I know there was a sponsor people were talking about, and there was a fraudulent Ponzi scheme. It was like 155 million. It just came out. It was an oil and gas company, and they had this thing called a depreciation recapture. And I hadn't heard of it before, but basically, let's say you or I invest 100K into the deal. In the first year, we can write off 200K. In my mind, that didn't make any sense. You know how that would be possible. They were touting 10% returns quarterly, 40% a year. Numbers that were nuts. And for me as a new investor, like, oh, that sounds phenomenal. But then you're part of that group and they say, hey, like, you probably shouldn't invest with this. We're not going to invest in this deal. And then, of course, it comes out that it's a Ponzi scheme. But the numbers are on the wall. When I'm looking at deals, I'm looking at things that are just simple, the numbers that make sense. Like I've talked to an investor and he says, we got a 346% return in a year. Well, that might have happened. That scares me as an investor because that almost seems like too good to be true. I just want my standard on these triple net lease, on the mortgage note deal. I just want it to be anywhere from 7 to 10% a year. And then on my multifamily self-storage deal, I want it to be overall between a 12 to 15% IRR. Just something that if it hits out of the ballpark, it does, but doesn't like, I feel like a lot of these sponsors, they might just put these numbers out there to get investors to entice them, where I'd rather someone say, we're going to get you a 12% IRR on your money and then give me a 15%. So I try to be very conservative, even on a more aggressive deal, if that makes sense.
Yeah, absolutely makes sense. Yeah. Being underwriting conservatively is something that I preach excessively. And what you're doing is exactly what I teach my clients. if something's coming across at a 150% per quarter gain,
Yeah.
that's obvious. Avoid that like the plague, that something's wrong. And talking about that Houston deal, that was one of those deals that was just too good to be true, right?
Yeah, exactly.
What are you currently working on? I know we talked about the getting real estate people on podcasts. Let's talk about that a little bit.
Yeah, so like you mentioned, so I had started that company back in my dorm room back in, what was it, 2017. To preface that, so I'd actually started my own podcast back in 2015 with a different company. So with that podcast, I was the host of the show. I was editing the show, doing show notes or the blog posts, the recap for the show. And after about 2 years of doing that, I didn't make a dime off it. But I self-taught myself all these skills, but I was also back in college. So what I did is I wanted to make some extra income. And I just started freelancing my skills on a platform called Upwork. You can hire people, you can find freelance gigs on there. And I started just editing people's shows for them, writing show notes. And then one day I came across a turnkey real estate investor out of LA. She wanted to get booked on podcasts. And I thought, well, I haven't booked anyone on podcasts besides myself, but I booked a lot of really good quality guests. Like I booked like David Osborne and Jay Papasan, co-author of The Millionaire Real Estate Investor. And I had spoken to them on my podcast, and these were the people I was landing. I thought, how hard could that be to get her booked on podcasts? Started booking her on podcasts. So that was going good. Then just started to find more people that wanted to go out there and get on podcasts on the freelance on Upwork, and just really did that for a year. I was like, wait a second, like this could be like a full-time business. I didn't have any employees. I didn't have any website. I just bootstrapped it all from the ground up, and then did that for about a year. I brought on my first employee, and then about 3 years in, we were working in a lot of different niches. I would take on any client that I could. A business coach, a health coach, a politician, a lawyer. We were working with them. And then I realized I'm stretching myself way too thin trying to be the company for all these niches. And I really like working with real estate investors. And then about 3 years ago, made that switch over to working primarily with real estate. And then that blew my mind, because then once I'm into there, you have your multifamily, your self-storage, mobile home park, your land flippers, your CPAs, attorneys. There's so many niches within real estate within itself. And that's, I think, why I enjoy the space so much. And that's one of the reasons why I wanted to get invest in real estate myself. But yeah, that's really how the company started. I wanted to make some extra bucks while I was in college, and then just grew, got some legs, and continued to grow. And I was like, hey, why stop now? And grew it to to where it is today.
It's awesome. Listen, I love the entrepreneurial spirit. Just hired somebody to help me run my property management company on Upwork. So I'm all about that freelance opportunity. So that's fantastic, man. Now, where are you going to take this company? What's your next step?
So really my goal from here is one, so the way that our packages were structured, so we had some clients on a monthly reoccurring package, and some, they would come to us, say, pay $3,500. We book them on 10 shows over a 2 to 3 month period. So when I've been working with my coach, what I've done is I've started to switch up everything. So everything is going to be on a reoccurring basis going forward. And the reason I'm doing that is I ideally within the next 3 to 5 years would like to position the company to sell. And my goal is to sell the company for at least $4 million. That's always been the goal. So it's a lot easier to sell the company when you have that reoccurring basis than on those one-off packages, as that's what I've learned from him. So my ideal goal is just to continue to scale the company up to about $1 million a year in revenue. And then once that gets to that, then sell the company for $4 million, because you get about 4x on that. And then really take that money and then invest in real estate and enjoy. It's been a long journey of building this company. And I look at myself and I'm like, I don't want to be doing this for, another 10, 15 years. It's like I enjoy it, but I have to deal with the headaches of clients, the headaches of team members, of always having to show up. And I enjoy it, but I don't want to be doing this forever. It's not something I necessarily thought I would be doing for this long, but it keeps turning a profit, and I keep taking that money and investing in real estate. So it works out well, but that's really the long-term play. And I know I don't want to I don't want to be doing it forever. I'd rather just look at that sort of next phase in my life. And I look back in time, I started a company selling bracelets and watches. Then I grew a motivational based company. And then from there, I jumped into this podcasting company. I'm like, what's that next phase? And it's almost like I'm bored at times because I've conquered that mountain. I've I have the clients, I have the cash flow coming in, I have the team built out. It's what can I do next that's going to challenge me? And that's what I really see within real estate. And I think eventually I'd like to be a syndicator myself and get like my friends and family in these deals. I really like the triple net lease opportunities, finding these commercial buildings. They just make sense in my mind. I like what they have to offer. And I think that's like that next journey, 5 to 10 years out is selling this company, having that nice little nest egg, and then building off that real estate company sometime in the future.
That's great, man. You're a true entrepreneur, man. I love the spirit, Trevor. It's fantastic. Now, you're building this empire, right? You're one company at a time, and you're consistently seeing results. What is one thing that you learned during this entire process?
I would say the biggest thing I've learned, one, to be okay with failure. And going along with those lines, like there's going to be hard times in your business. There's going to be ebbs and flows in your business where we have the down period. Like right now, I consider we're in a down period. We've lost about 30% of our revenue in the last 6 weeks from people just pausing their contracts. Mm-hmm. We have about 10 clients right there at the door. The invoices are sent over. We're just waiting for them to pay. So it's a frustrating time, but I know that it's not going to last forever. And then there's points where, people are going to pay, at least in our company, they're going to pay all at once. That's just the way that it happens. So there's always going to be these ebbs and flows. And I think what helped me see that was hiring a business coach. So I think I made that shift about 2 or 3 years ago. I hired a business coach. So I worked with the same one for about 2 years, and he was phenomenal. He helped me grow my business to where it was. And then I realized I outgrew him. He was very good, but I wanted to get that business to the next level, and I wanted to sell my company. That was my next goal, was how can I grow it to sell it? And that's when I started working with this new business coach. I looked at him. He sold a company for 2.5 or 2.4 million on his own. And then I was like, he's done it before, and he scaled his company up in under a year and sold it for 2.4 million a year. And I've been at this thing for 6 years. I need that outside guidance. So I think having that guidance of hiring a coach is just instrumental. Like he's further along than I was, and he helps me see the blind spots that I don't necessarily see. And then it goes back to just having that positive attitude when you encounter these different failures that you're going to have in your business. And even if you are in real estate, there's things that are going to happen. A tenant doesn't pay, a deal falls through, your property taxes. I know in the town, when I was living in Massachusetts, they bumped the town's property taxes up 20% in 1 year to deal with COVID-related expenses and things that are going to hurt your cash flow. That's just going to happen. But I always say you're going to figure it out. It may seem like the worst in the moment, but it always is going to work out in the end. And you just got to have that positive mindset when things go wrong.
Yeah. I'm guessing those people are sending those invoices right around the 1st or 5th of the month.
Exactly.
That's usually what I'm running into with my coaching program. It's usually right around the 1st. They're like, I'm going to pay you as soon as I get my rent.
Yeah, exactly.
That's great, Trevor. I love where you're going. Thank you for all that information. So we're going to get into the Soaring 4. Are you ready to take your real estate investment sky high? The Aim High REI is the perfect Facebook community for you. Get answers from experienced investors, connect with other motivated individuals, and benefit from valuable resources all in one place. If that sounds like something that interests you, join our amazing network today, and we will help elevate your investing journey beyond what you think is possible. That's Aim High REI on Facebook, or click the link in the show notes. The best part, it's completely free. These are the same 4 questions that can help someone who is just starting out achieve new heights. What is one thing that you use to keep you motivated?
I would say for me, it's just having goals written down. So I have my goals written down. I review them every day. I have tracking sheets set up for them. And then I go through the tracking sheets once a week and update my progress on them. So for a goal for me might be investing in my next real estate deal. So I have a number tied to that. So I want to invest $50K into real estate this year. And then I whittle it down to how much exactly that I want to have invested. So $50K, then you do the math over 12 months. You're looking at what, $4,300 a month. And then I whittle that down. I find that gives me motivation. And then I tie like a certain goal to it where I know, hey, if I hit that goal, I'm going to buy myself a new set of golf clubs. If I hit this goal, I'm going to take me and my wife out to a nice restaurant. I find that keeps me motivated, because if I didn't, I would just invest that $50K into real estate and then restart that process the next year and then not have that. It's like you're working so hard, but you're not getting any of the rewards out of it, where I find having that incentive that I tell myself saying, hey, I want this new $700 pair of golf clubs. If I invest 50K in real estate, then I can buy those for myself. And I find that helps me motivate. And it also gives me something, a starting line to figure out, hey, this is where I want to go, instead of saying, I want to invest in real estate this year, but how much? I don't know. So just having that written down and tracking that progress every week really keeps me motivated. And then you can see, as I write it down every week, hey, I invested $800 in this week. Hey, I invested $1,000 this week getting ready for my next real estate deal. Then you can track all that progress, and it definitely helps keep me motivated.
Okay. What is one thing that you learned that completely changed your mindset?
I would say one thing that I learned was probably has to go back to charging more. I always found early on when I was doing the company that I never wanted to charge. I never wanted to charge more than I thought that I could afford as someone that was beginning. And then I realized that, yeah, I might charge someone 6K. I've had people pay us 8K to use our services. Like 8K to me seems like a lot of money. But for some of our clients that are very successful, 8K is like nothing to them. And I can't let my mindset on money, especially as a college student, when you have a couple $100s in the bank, and it was hard for me to sell someone on an 8K package before. And then I realized, like, hey, this person has the money that's out there. They're successful. We offer a good service. So that was just like a learning curve for me. And I had to learn that, hey, the money's out there. I can't let my preconceived notions hold me back from charging what we're actually worth. And that was something I definitely had to learn and realize there's people that are willing to pay a lot of money to use your service. You just have to find the right people and sell it to them on a good level.
We usually do sell ourselves short, don't we?
Yeah.
Like, oh yeah, I think I'm worth this. And then somebody's willing to pay so much more. It's amazing. We undervalue ourselves, unfortunately, too much. So what tools do you use to keep yourself on track?
I would say for me, it goes back to, I know I mentioned that worksheet, the goals that I go off every week. And then what I do is, I actually did it today because I'm going to be taking Friday through Monday off for the holiday. Give myself a little rest. But typically what I'll do on Fridays is I have a notebook, and I'll just write down every single task that I have to get done during the week. And then I'll break it out like Monday, Tuesday, Wednesday, Thursday. And I typically leave Friday open just in case things come up that need to be addressed. And then I set it up that way. So Monday are like, those are the things that I absolutely have to get done during the week to get my business, whether that's editing a podcast, whether that's doing a new marketing strategy, whatever that may be. I save that for Mondays. And that's really how I organize my week. Every Friday before I head out for the day, I'll just write down, basically brain dump everything I need to get done on a list. And then I'll break it out Monday through Thursday and write down everything that I need to get done. And that really helps me stay focused on the most important tasks. And then obviously Thursday, those are the tasks that I like to get done, but they don't necessarily need to get done. That's why they're on Thursday. But Monday, it's like, hey, I got to get these tasks done for the week to make the week a success. And that's, at the end of the day, I find there's only 4 or 5 really strong tasks I need to get done in the week. If I can knock them out on a Monday, it's like the rest of the week is going to be a success no matter what happens.
Yeah, man. And then what is one thing you'd change if you had to start all over?
I would probably invest in real estate earlier. I think that was for me. I think it was like, I was just so on the fence of doing it, even though I had the clients where it was just like that intimidation factor. None of my friends and family had invested in real estate. It was all 401ks and IRAs and different things like that. So for me to go out there on my own and invest 25K, which is not that it's a ton of money, but it's a substantial money for someone that's doing their first deal. But that's how you still gotta get started. For the majority of these deals, you're investing 25, 50, 100K at a minimum. I even came across a sponsor. His minimum was 1 million to invest with them. But you gotta, for me, it was like, if I could invest sooner and get that cash flow coming in earlier, I would have done it tenfold. So that was something I just wish I pulled the trigger earlier and didn't just keep reading about it and networking. I wish I just would have pulled that trigger a little bit earlier than I had done.
Great. And Trevor, listen, thank you for your time. Thank you for everything you brought to the table. If somebody wanted to reach out to you, how would they do that?
Sure. So they can, check out our site, podcastingyou.com. That's just podcastingyou.com. Or feel free to connect with me on LinkedIn, just under my name, Trevor Oldham. You should be able to see me there, and happy to connect either way.
Fantastic. Again, thank you very much. I know you're busy, and congratulations on the success that you've had so far, and I wish you the best in future success. Until the next time, aim high.